Hello traders, this is Dion. Welcome to my channel. In this video, I want to show you a simple way you can identify high probability fair value gaps. Now, I wanted to make this video as simple as possible. So we are only going to look at three things here. What is a fair value gap? Types of fair value gaps, and how to identify high probability fair value gaps. In this section, I'll also show you the real chart examples. So just stay tuned to the end. Also, if you are new to this channel, please consider subscribing. You can also join my free Telegram channel. Also follow me on Instagram. All right, so what is a fair value gap? Okay, in simple terms, these are just imbalances left in the market when one side is more dominant than the other. On this point, I'm just talking about market direction. Okay, sometimes when the market is bearish, meaning the selling pressure is dominant. All right, so the imbalances that are going to be formed are going to be bearish fair value gaps in this case. Okay, so like it is already pointed out here, when sellers are dominant, we have an imbalance in a bearish direction. When buyers are dominant, we have an imbalance in a bullish direction. All right, so the first type of fair value gap that we can talk about is a BC, which is just a buy side imbalance, sell side inefficiency. So this is a three candle pattern. Okay, it's a three candle pattern. The only requirement that you need with these three candles is that this first candle's high should not touch the third candle's low here. All right, this void between this first candle's high and the third candle's low, this is what we call a fair value gap, or a BC right here. This is buy side imbalance and sell side inefficiency right here. Okay, so in short, it's just a bullish fair value gap. It's just a bullish fair value gap. If you mark it as just fair value gap, it's fine as long as you know what you are looking for. All right, and the next fair value gap that we can talk about is the CB. So this is just the opposite of a BC, as you can tell here. This is just sell side imbalance and buy side inefficiency. Okay, in this case, sell side was offered, but buy side was not present, causing inefficiency. So you see at a certain point the market will just move aggressively to the downside. Okay, and then the next candle that follows will not go back to rebalance whatever distance that was, whatever void that was left here. It will just go on its way there. So this first candle here and that third candle will create this void. Okay, this void that is going to be left. So just like the BC is also a three candle pattern, you need the first candle's low not to touch the third candle's high. Then you have a BC. In short, it's just a bearish fair value gap. It's just a bearish fair value gap. All right, so the third fair value gap that I'll talk about is an inverse fair value gap. So in some situations, the market will take out a fair value gap. All right, we making it a failed fair value gap, but it's not a completely failed fair value gap. It can still be used at a certain point in time. Okay, so what happens is that, for example, here you can see this is a CB. The price was going to the downside, left this bearish fair value gap here. So normally you expect the market to react to this fair value gap. Okay, this is reacting as a resistance, but the market went through okay, and then came back. This was a resistance area, but now it became a support area. All right, so a CB is going to act as a support, and a BC is going to act as a resistance. Normally, a CB reacts as a resistance because you are expecting the market to go to the downside. All right, but the price will just move into that fair value gap aggressively, take it out. The way the market has to, this is how you know that this is no longer a CB. Okay, a candle's body must close above this fair value gap. That's how you know that it has been destroyed. Not when just a wick goes through here and then closes within the same fair value gap, then this is still a valid CB. Okay, but you need one candle to close. You just need one candle to close with a full body candle above. Okay, then you have a failed CB, but it's not completely failed. It can be used again at a certain point. So this is where you mark it as inverse fair value gap, because price can just go back again, react to it, and then start rallying to the upside. And our fourth fair value gap example, this is a balanced price range. All right, so among these fair value gaps, this is my favorite actually. This one tends to be of higher quality compared to the other three. So what happens in this case is that just like an inverse fair value gap, you have this level, a CB, okay? You have this bearish fair value gap, which is destroyed. All right. Now, in the process of destroying this fair value gap, you have this first candle here that I labeled first. You have the second candle, and then you have the third candle. Between the first and the third candle, you have a fair value gap. So the market left a fair value gap in the process of destroying this fair value gap here. Okay. So in this case, you have an inverse fair value gap and a new fair value gap. So you have a CB that failed here, okay, and then all of a sudden you have a BC that has formed here. So that failed CB is now an inverse fair value gap, and then you have a BC here. So you have an inverse fair value gap and you have a bullish fair value gap. They all intersect at a certain point. So you can see this dominant yellow. I don't know if it's yellow or yeah. This area right here where I've marked BPR, this is the balanced price range. So the market, in most cases, you can see here with this red candle, it reacted to the inverse fair value gap first, okay, tried to go up and then came down. It comes down to that BPR and then explodes to the upside. So if you are not aware of the balanced price range, you'll be very surprised by the aggressiveness in price movement here. Okay, so this area, these are just overlapping fair value gaps. Okay, the overlapping area of the two fair value gaps act as a magnet for price. Price tends to come back to this area because there's way too much price action that needs to be done here. Okay, this is also called internal liquidity, by the way. Yeah, but you don't need to know that right now. We'll make a video on that. Okay, so let's just go to the real chart now. All right, so just to give a few examples of the fair value gaps that we've been talking about, here's the British pound US dollar pair. So here you can see here the market was going down, and you can see just between that low and that candle's high there, we have a fair value gap. Okay, right here. Yeah. So if you are looking maybe for a point of interest for you to take a trade, of course this has to be paired with market direction, bias, and or the liquidity grab setups that you need. Okay, you definitely need other things for you to just take a trade in a fair value gap. Okay, but here I just want to show you how you can identify these fair value gaps. All right, so this one we can call it as SCB. Since this is a bearish fair value gap, so we have a sell side imbalance, a buy side inefficiency right here. Okay, I don't want to explain too much. So that's one example of a CB. You can go down here again, and right here you have a BC. So this is your BC right here. Okay, this one was actually a nice BC because if we are looking at liquidity here, you had these relatively equal lows there. When you go down to the lower time frame, those are relatively equal lows. Yeah, and then they were swept by this candle right here. So this was a nice BC right here. Okay, when the when price comes down and then goes through a fair value gap like this, it doesn't mean the fair value gap is not valid. Okay, it only becomes invalid when the when a candle closes with a full body candle below it, in this case. Okay, here this is a void. Okay, so it needs to be filled. It's a void, it's an imbalance. So you see in most cases candles just spiking down and then going to the upside like this. Okay, can even stretch it out like that. Yeah, so the market will just be playing around here. The market is just taking out liquidity in this case. So this is why I'm saying this was a nice BC right here. This was a nice bullish fair value gap. Okay, because you have this swing low here, and then the market just came down, took off liquidity here, and then closed within the same fair value gap. So this was a nice one. All right, so what we have here is an inverse fair value gap right here. You can see this was a bullish fair value gap, or a BC if you like. So you expect the market to respect this bullish fair value gap when coming down, but instead it just went right through it with full body candles closing below it. So this was a failed bullish fair value gap. All right, so this becomes inverse because this is just a reverse of our expectations, where you expected the market to go like this. Okay, you expected the market to go like this, bounce here, and then go to the upside. That's your expectation, but this didn't happen. All right, the market broke it and then tries to go down again, then went back. All right, went back and started reacting to the same area. So this is an inverse fair value gap. Inverse fair value gap. That is an example of an inverse fair value gap. This also shows a lot of selling pressure. Okay, if the market, especially if the market has not changed character yet, you don't have a market structure shift yet, and then this happens, you can expect the market to change character. Okay, at any point. Yeah, so the market mostly starts uh, with this movement right here. All right. And here we have a balanced price range right here. These I actually prefer having a balanced price range compared to these other fair value gaps. These tend to be more higher quality because what you have is first you have this failed fair value gap which became an inverse fair value gap. Okay, so you have that inverse fair value gap. Okay, and then you have a fair value gap right here, a fair value gap that was caused by this aggressive drop to the downside. So you have a fair value gap right there. So when these two come together, they tend to make higher quality reaction zones for price. They tend to make this high quality reaction zone for price. When price come to that zone, you can see how just after reacting to the two zones, it just spiked to the downside like that. Yeah, so this tends to be of high quality. Also, there was a liquidity sweep here, so this was a really good. If you were going to enter here, you are definitely going to make something out of that trade. So you are not just identifying these fair value gaps. You also have to pair it with market direction, liquidity sweeps, and bias, higher time frame bias. You have to make sure you pair it with higher time frame bias. Okay, and by bias, most I mean the daily. Okay, you should try to pair it with the daily bias. The daily bias is going to make a lot more difference in your trade. All right, so when I say you can pair it with the daily bias or higher time frame bias, this is what I mean. This is just one of the many examples. So you can see there's a daily fair value gap here. All right, but when you go down to the lower time frame, you have this. Okay, in the lower time frame, you have this. You have this bullish fair value gap there, and the market is already reacting to that fair value gap. So when you pair this with the liquidity grabs that was happening here, and also you pair it with time, okay, you can see this was 003 New York time, which is still in the London session. Okay, and London session, if you know trading sessions very well, London session tends to manipulate the market. Okay, it tends to manipulate and then it goes to wherever it's going. So here you can see it already took out sell side liquidity here. It took out this swing low. Okay, took that out, reacted to the bullish fair value gap. Now this just gives you some extra confidence because already you know that the bias is supporting your entry. So this buy side fair value gap is just extra confirmation for you. You already have the bigger picture. All right. So these fair value gaps are best used when they are paired with bias, okay, liquidity grabs, and price. I mean, time. Okay, you have to know the time when you are. Do not trade outside trading hours. All right, I would advise the London session and the New York session. That would be best for you. Otherwise, thank you for listening. You can still join my free Telegram channel. It's in the description below. You can also follow me on Instagram. It's a okay. I just opened the Instagram account, so you can follow me there. I post daily tips on how you can elevate your trading. All right, guys. Until next time, happy trading.